Welcome to 2026, the year the extend and pretend game officially runs out of road. While the media was busy distracting you with holiday fluff pieces and telling you that the economy achieved a soft landing, a ticking time bomb buried deep in the balance sheets of America's banking system just hit zero. We are standing at the foot of what Wall Street is terrified to talk about in public but panicking about in private: the maturity wall. Specifically, a staggering $1.8 trillion wave of commercial real estate debt that is coming due this year. To put that number in perspective, that is larger than the entire GDP of Australia. And it is all backed by empty office buildings, deserted strip malls, and luxury apartment complexes that nobody can afford to rent. For the last 3 years, banks and landlords have been playing a game of chicken with reality. They pretended that interest rates would go back down. They pretended that workers would return to the office. They pretended that their assets were still worth what they paid for them in 2019. Well, as of this week, the pretending is over. The loans are maturing and the refinancing math is nothing short of a catastrophe. You have to appreciate the irony of the situation. The same institutional geniuses who lectured you about buying too many lattes and not saving enough for a rainy day are now sitting on the biggest pile of bad debt in human history. These landlords bought properties when interest rates were near zero, leveraging themselves to the hilt, convinced that money would be free forever. Now, they are walking into the bank to refinance those loans, and they are getting hit with rates that have doubled or tripled. It is a mathematical impossibility. A building that barely made a profit at 3% interest is structurally bankrupt at 7% or 8%, and the savage reality is that the banks know it. They know the keys are coming back to them. We are about to see a wave of jingle mail, where developers simply mail the keys back to the bank and walk away, on a scale that will make 2008 look like a minor correction. But unlike 2008, where the problem was poor people with subprime mortgages, this time the problem is the smart money. It's the private equity firms, the pension funds, and the real estate tycoons who thought they were too big to fail. But before you laugh at the misfortune of some billionaire developer losing his skyscraper in downtown San Francisco or Chicago, you need to understand who is actually on the hook for this disaster. It's not just the developers, it's the banks. Specifically, the small and mid-sized regional banks where you likely keep your checking account and your business payroll. These banks are absolutely stuffed to the gills with this toxic commercial debt. They loaded up on it because it offered a slightly higher yield. And now that the valuations of these properties have crashed by 40%, 50%, or even 60%, the collateral backing these loans has evaporated. The bank is technically insolvent. They are lending against ghost towns. This is why the start of 2026 is so dangerous. As these loans hit their maturity dates starting this month, the defaults will start to roll in. When the defaults roll in, the banks have to write down the losses. When they write down the losses, their capital reserves vanish. And when their capital reserves vanish, the FDIC steps in on a Friday night, and by Monday morning, your local bank doesn't exist anymore. This $1.8 trillion wall isn't just a number on a spreadsheet. It is a direct threat to the solvency of the U.S. banking system, and the first domino just tipped over. To understand why this crash is guaranteed, you don't need a PhD in economics. You just need a calculator and 5 seconds of common sense. The entire commercial real estate market runs on a simple formula. You borrow money to buy a building, you fill it with tenants, and the rent pays the mortgage with a little profit left over. In 2021, developers were borrowing at 3% interest. Today, they are looking at refinancing rates of 8% or higher. But here's the fatal flaw that nobody discusses. The building is worth half of what it was. If you bought an office tower in downtown Chicago or Los Angeles for $100 million 5 years ago, today that building is likely worth $50 million. But you still owe the bank $80 million. Do the math. You are underwater by $30 million. No sane bank is going to refinance that loan. They are going to demand you bring $30 million in cash to the closing table just to keep the keys. And guess what? These developers don't have the cash. They spent it on dividends, stock buybacks, and luxury yachts, assuming the free money era would never end. This is where the so-called urban doom loop begins to spin out of control. We are witnessing the creation of zombie buildings, skyscrapers that are technically open but are practically dead. Walk through the financial district of any major U.S. city today. It feels like a movie set after the actors have gone home. The return to office mandates were a desperate failed attempt to force workers back into these cubicle farms to save the landlords. It didn't work. Vacancy rates in major metros are sitting at record highs, nearing 20-25% in some cities. When a building sits empty, it doesn't just hurt the landlord, it destroys the city. An empty building doesn't buy electricity. It doesn't need janitorial services. The workers who aren't there aren't buying $15 salads for lunch or paying for parking. This obliterates the local tax base. And when the city loses tax revenue, what do? They raise taxes on the few people left, or they cut services like police and sanitation. This makes the city even less attractive, causing more businesses to leave, which creates more empty buildings. It is a death spiral. The banks are fully aware of this loop. They have been quietly engaging in a strategy called extend and pretend for the last 2 years. They let the borrower skip a few payments or extended the loan for 6 months, hoping that interest rates would crash or that a miracle would happen. Well, the miracle didn't show up. The Federal Reserve has made it clear that we are in a higher for longer environment. The extensions are expiring now in January 2026. The regulators are starting to ask questions. They are forcing banks to mark these assets to their real value, not the fantasy value from 2019. And when they do that, the capital ratios of hundreds of regional banks fall below the legal limit. This $1.8 trillion wall isn't just about empty offices. It is about the sudden realization that the collateral backing the U.S. banking system is effectively worthless. And if you think the government has the money to bail them all out this time, you haven't been looking at the national debt clock. So, why should you care if a few banks collapse and some landlords lose their shirts? Because in a debt-based economy, contagion spreads faster than a virus. When these regional banks start eating losses on commercial real estate, they don't just close up shop, they stop lending to everyone. This is the credit crunch of 2026, and it is going to hit you a lot harder than the Wall Street crash. These small and mid-sized banks account for nearly 70% of all small business loans in America. They are the ones who finance the local bakery, the construction company, the mechanic, and the family farm. When the bank is fighting for its own survival because of bad office loans, they cut off the credit line to your boss. When your boss can't make payroll because his line of credit was frozen, you get laid off. This is how a problem in a Manhattan skyscraper ends up costing a welder in Ohio his job. The soft landing narrative was the biggest lie ever sold to the American public. There is no soft landing when $1.8 trillion disappears from the ledger. We are already seeing the cracks form in the residential market because of this. You might think your house is safe, but real estate is all connected. When commercial property values tank, the tax burden shifts to residential homeowners. Cities are not going to just accept lower tax revenue. They are going to jack up your property taxes to cover the deficit left by the empty office towers. Furthermore, as liquidity dries up, getting a mortgage or a car loan is about to become a nightmare. We are entering a period where cash is king and debt is a death sentence. The banks are scared, the developers are broke, and the Federal Reserve is trapped. If they print money to bail out the banks, inflation explodes again. If they don't, the banking system collapses. They have no good options left. The year 2026 is not going to be about growth or innovation. It is going to be about survival. The great reset of asset prices has begun. The $1.8 trillion wall has been hit, and the dust is just starting to settle. If you're sitting there with variable rate debt, zero emergency savings, and a blind faith that the government will save you, you are standing on the train tracks while the engine is barreling down on you. This is the year the bill comes due. The developers partied for a decade, the banks enabled them, and now they're going to hand you the check. Don't pay it. Get lean, get liquid, and stop trusting the institutions that built this house of cards. The crash isn't coming, it's here. Welcome to the reality check.